Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. Welcome to this edition of Next Level Charting. So it's Thursday, May 7th, and today I want to talk about the immediate trends and seasonality. SPY is still in its danger zone, but it's still in an uptrend. We'll show you the key level to watch. Small caps are lagging, though. Then we're going to look at 20-year seasonal patterns, and then I want to show you a twist on seasonality. We're going to go 30 years, and we're going to look at the equity curves for monthly seasonality. Which month has the most consistent and persistent equity curve? So let's first check in on SPY because it really is the benchmark for the market, of course, because it represents the S&P 500. And looking at this chart, you got this big surge, a little pullback, and another big surge. And we got that close above the 50% retracement there in the middle of April. And then you can see we've been largely flat since the middle of April. For around 3 weeks, we've been flat. But this flatness does have an upward drift here, you can see. But we're still in a danger zone because we had this big breakdown decline here. And this advance is retraced 61.8%. And it is still below the 200-day moving average. And so we had that pullback last week. We're trying to get a bounce this week. And so I would mark that first support level at 280. And if we close below that level, then we have a potential short-term reversal on our hands. Now, if you look at RSI, this is just 10-period RSI, and you can see that it moved above 50 there on April 6th, or maybe it was a day earlier. But you can see that it's held above 50. And that means the momentum cup is half full as long as it holds above 50. And if RSI moves below 50 there, then that would signal a downturn in momentum. So those are two things to watch short term. And the reason the short term is so important is because we're at a make or break point here as we're below the 200-day. We're near that key retracement area, 61.8%. And so if we do break down here and reverse, that could signal a continuation of this decline. I wouldn't expect it to be as sharp, but it would be a continuation of this bear market event that we had in February, March. So here is RSP, the equal weight S&P 500, and right away we can see that this one is not quite as strong as the S&P 500. In fact, you can see it didn't make it up to the 61.8% retracement. It's well below the falling 200-day moving average. And you had this decline last week, and it is yet to fill that gap. And it's down today as I speak on Wednesday afternoon at 1:30 p.m. Eastern Time. So again, this looks like the decline that broke the bulls back and started a bear market. This looks like the counter trend bounce, and it looks like we may be continuing lower. Now, if we go down further in market cap, we're going to get to mid caps MDY. And we had these triangles form, and we had breakouts last week with big surges, and now we're getting throwbacks. And this really puts the market at a make or break level because, or it's also showing that there are two competing forces at work. You have the bigger downtrend at work after this big breakdown here, and then you have the short-term uptrend at work, and they're colliding right now. That bigger downtrend is trying to take over again. And the short-term uptrend is not giving up quite yet. You can see the breakout there, but it didn't go far. You had a pretty hard throwback here. And so I think I got a next chart here that shows IWM and IJR with some rising channel and wedge lines to watch. So there's IJR. And you know, it surged and it gave pretty much all of it back. And it's right at support. And if it breaks down here, then that signals a continuation of this decline and a move lower. And then if we look at IWM, the Russell 2000 ETF, there you can see the breakdown, the surge. There's the pennant and the breakout. And this is the thing, you know, if you're playing short-term breakouts in this kind of a market, a bird in the hand is worth two in the bush. All right, you don't need to get greedy here in this volatile environment. And you can see here, this is a wedge of sorts. And if we break this support level, we'll call it 120. That would be a bearish development. That would reverse this uptrend and signal a continuation lower. So I don't use seasonality very often, and I know hindsight is definitely 2020, but the month of April is clearly the best month for the S&P 500. May is not a bad month either, but you can see the average gain loss is flat there. So this is a 20-year seasonality chart for the S&P 500, and the percentage numbers show you the percentage of times the S&P 500 was up in a particular month. And there you can see April at 80%, November at 79%. Those are the months that have the most chance of being up. And then the biggest gains, average gain 2.5% in April, average gain 1.7% in November. Now, this seasonality chart tells you some basic numbers, but I want to dive a little bit further, and I want to go back 30 years, and I want to show you the equity curves for each month. In other words, if you had bought each month at the rate of change basically for each month and how that would have performed over a 30-year period. So I'm going to show you some equity curves for that. And this will be seasonality because, it's not just static. There are ebbs and flows, but April is the only equity curve that shows a clear trend. So I went to Amy Broker, which is a backtesting platform that I use, and I ran some tests on the different months of the year. If you had owned only that month, how many winners and losers would you have? And this is just sorted by month, January, February, all the way to December. And there you can see the number of wins, number of losses, and the winning percentage, which is very important. There you can see April at 77%. And then when you had a win, what was the average gain and what was the average loss? And then I've got a gain-loss ratio. Was the average gain bigger than the average loss? If so, it's above 1. If not, it's below 1 like it is for May there. So here we are sorted by win percent. And you can see the best 3 months, April has the most winning months. 77% of the time it's up. December and November are also up over 70%, and May is up over 70% of the time. So much for sell in May and go away. The 6-month strategy really isn't that great. You really should probably be selling in June, because if you look at June, it's only up 57% of the time, and the average gain loss is barely positive here. So clearly, April, December, November, and May are your best months. October is also a good month for the stock market. So we got May here right now. Now I'm going to go down and look at this different sort here. Now I'm sorting by the average gain, average loss ratio here. And we can see that July has a big positive ratio. March, April has one of the higher ratios. So April has a high win percent and a high ratio. And as I said, yeah, I know hindsight is 2020, and this does not include April 2020. I like complete years. So this is 30 complete years. And so April was one of the best months going in to, last April. And then you can see October is up there. So October is a good month. And May slips into the bottom half because the average loss was bigger than the average decline, even though there were fewer losses. But what this means is that, May can have some big losses. You think of the flash crash. So it's kind of takes away from that 70% win rate. And now I want to look at the equity curves for some of these. And just a little note on what we've been covering at Trend Investor Pro this week. On Tuesday, I put out an article where I tested crossover signals using the stochastic close indicator that I developed for trend following on a basket of ETFs, 10 alternative ETFs for bear markets and 40 stock-related ETFs for bull markets. And then also on Tuesday, had an article out, the short-term glass is half full, and I was looking at the percentage of 20-day highs in the S&P 500 versus the percentage of 20-day lows. We've seen 20-day highs dry up, but we have yet to see an expansion of 20-day lows, and that could be a signal that we're turning down, because that's kind of what we had at the end of February. And then I looked at prior bear market bounces to apply the lessons to the current bounce, and that also includes a video with lots of charts, of course, that you can see in the written commentary. So now I want to show you the equity curves for this seasonality. And what the equity curve is basically if you only own stocks in January of each year for the last 30 years, what would your equity look like over a 30-year period? Would you have a consistently rising equity line? Would it be falling, or would it just be all over the place? And we can see from these equity lines how the trends in seasonality have changed over the years, or maybe have not changed. So if you look at January here, you can see that the equity line was rising in the 90s. So January was a good month to own stocks in the 90s. 90s were a great 10-year period. But then, you had the 2000 bear market, so the equity curve was kind of flat. And then you had the bear market, and January's didn't perform good in the bear market. And then you can see you got a bounce there. January started performing well, then they underperformed, and now they're performing well again, January's. Next, we're going to look at February. And February, you can see in the 90s performing well, but not in the first bear market, 2001, 2002, into 2003, a little reprieve, and then the other bear market. And then in the bull market, it performed well since 2009, roughly. So pretty much February performs good in bull markets, bad in bear markets. Here's March. Now, this is a much different looking equity line. All right, it is much more stable and consistently higher. Sure, it's flat in the 90s. It goes up. It's flat 2000 to 2008. And then 2009, it rises. But it didn't take the hits that the other equity lines did. So March looks like a pretty good month. And then look at April. This blew my mind when I saw it. This is one of the steadiest seasonal uptrends that you'll see. April is a steady month when it comes to stocks because the equity line just rises. All those little spikes are what happened during the month because it's on basic days. So you buy at the close of the previous month, March 31st, and you sell at the close of the month, April 30th. And then May. How does May look? Well, May's kind of flat. I mean, there's nothing really there. Sure, it did good in the 90s, but then started doing not so good, but did good again in 2003 to 2009 even. And then not so good after the bull market started in 2009, started doing good again, but then got hit hard there in 2019. You also had the flash crash here in 2010 that hurt May. So May's been, flat for the last 20 years overall. Well, unfortunately, that is all I've got time for today. The rest of the charts will be made available on trendinvestorpro.com in a PDF. All right, so that concludes this edition of Next Level Charting. Again, this is Arthur Hill with trendinvestorpro.com. Thanks very much for tuning in and have a great day.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.